So here we're going to go deeper onto the consumer side and obviously inflation is an impact, but we talked a lot about inflation, probably too much. And here we want to go deeper into, well, how is this impacting consumption? How is this impacting the consumer? So one of the key pieces that we've been talking about is the growth in debt and the growth in credit that is being consumed. And so total credit card spending per household is continuing to slow as the last of the stimulus impacts obviously wear off. Just another sign that consumption, the leading driver of obviously U.S. economic growth, is slowing meaningfully. So you're seeing it come down, but it's still expanding. So you're still not negative when you're looking at, but this is gross spending. So then when you take this, and we're currently spending at just below 4%. So then as you take that and adjust it for inflation, you get an idea that we are negative on a real basis, but still on a nominal basis, you're still seeing that positive contribution. We just think that this continues to trend lower as people, again, tighten the reins, try to rein in that spending, especially as some of these pieces on the wage side get worse. So another recent spike higher, so wage growth has turned lower again for non-supervisory work in leisure and hospitality, which underscores that as hiring continues to pick up in the sector, wage growth has eased. So wages are coming down. Again, they're still obviously higher going when you go back through the 80s, but you're seeing this pressure now where, okay, wages have come down a bit, but inflation hasn't. So you're seeing wages come down further, which again is going to just make real available discretionary spending, real wages go that much worse, making it harder and harder for people to say, okay, well, I'm going to go out to dinner an extra time. I'm going to go on vacation. These are the things that people are looking at and saying, I just don't have the capacity, because I'm seeing my everyday price go up. Every week I go to the grocery store, the bill gets higher. Every time I get my utility bill, it goes up every time. And so again, all of these things, while wages are not matching that. So that's eating into the discretionary cash. So the average hourly earnings employees, so workers in manufacturing sector, have seen their inflation-adjusted earnings shrink back to 2014 levels. And again, this is now inflationary adjusted. So you're seeing the pressure continue where wages are not keeping pace. They're coming down further while inflation continues to go up, especially in these core sectors. So you're seeing rents are going up. They're when you look back over the last couple of months, it's over a 1% increase. So as this goes up, but you have wages either stagnating or actually going down, while rent, your biggest expense on outside of, unless you pay for your own healthcare, because for me, my healthcare and my mortgage cost the same. They are the same number. And once you factor in actually using a doctor, actually using everything, my healthcare monthly cost is higher than my mortgage rate, my mortgage expense. So here, when you look at rent of shelter, this is a huge impact to people because it is either the number one or number two expense they make per month as their wages don't keep pace. But then other things are decelerating, but even as they're decelerating, we're still getting a broad increase. And again, new vehicles, used cars and trucks, a lot of this is going to kind of flatline. We should start to see this roll over. But when you're starting to see some of this offsetting piece as rents go up and stay elevated and continue to actually accelerate up, that's going to offset some of these movements. So as margins compress, inflation is expected to fall quickly. And this is where we struggle because when you look at PPI, it continues to remain elevated. And this is where we push back on some of these components where we just don't believe that core PCE deflator is going to pull back that fast. We think that there's a lot of staying power up here. There's a lot of those tailwinds that will keep us bid, but again, it's kind of keeping us back and forth, in terms of where we can actually see some of the deflation come through. So the decomposition of month-over-month change in core PCE, there was always the view that it was supply-driven, but as supply, which was obviously true, I'm not saying it wasn't, But when you look at the supply side versus the demand side, you're seeing that the demand side is still has taken over with supply issues still remaining. Again, they're not going away tomorrow, but the demand component continues to be the biggest driver of core PCE. And the question is, when does demand drop? And the problem that we have right now is we had that shortage of inventory, and depending on which inventory we're talking about, we need to see the demand. So yes, the consumer is saying they feel or their sentiment is negative, but they're not they're slowing their spending, but not at the same rate in which they're saying that they feel terrible and concerned about the economy. So that we need to see the demand side really accelerate to the downside in order to get core PCE at the levels that they're talking about. So this is the problem, because if they're right, and by they, I mean the Fed, if the Fed is right on core PCE, we're in a recession. If they're wrong on core PCE, maybe we have that soft landing. So they're saying that core PCE is going to collapse, but it would take demand to collapse, which is the biggest driver of GDP, which would then mean that we're in a steep recession. But they're saying that there's going to be a soft landing. We're not going to have a steep recession. So core PCE should stay elevated versus. So again, you're getting an idea of some of the failed logic, if you will, with some of their underlying pieces of what their expectations are for not only growth but also inflation. Now, consumer credit slowed, but when you look at it, it's still above the peak from 2019. We still have a record. Now we have a new record of revolving consumer credit owned and securitized. So this is going to put more pressure, but household debt service ratio, household debt to income, because anybody that could, and the problem is this is skewed because this is assuming a lot of people, which some did, refinance their mortgage when they got a new home. They have obviously a lower rate, so that enables them to have a lower, when you're thinking about interest expense per month. But a lot of these households, as I've learned, and as my wife keeps yelling at me, that everybody, because I just don't understand when I see these people, I'm like, how are they affording this? And she tells me because they borrow on their credit cards and they live paycheck to paycheck. So as credit card rates go up, this can move the household debt service ratio exponentially and quickly, especially because people are maintaining their spending or their lifestyles increasingly and at a record pace never seen before on credit. And that, again, can change that dynamics quickly, which is why when you start looking at the shrinking paycheck, so falling real wages in the US and UK are sparked labor demands for higher pay. So again, real wages falling, but if you start to see wages going up and starting to now keep pace with inflation, that creates the wage spiral. So when you start thinking about a wage spiral, if I true someone up, so say for an example, I see inflation at 9%. So I give an employee an increase in their pay of 10% to say, look, I'm going to cover, any momentum, and I'm going to cover inflation at this point. I am paying that person now 10% more. So I have to turn around and recover that by raising the price of my goods that I'm selling or a service that I'm selling in order to cover his higher or her higher wage. But now, as everybody does that, which means that everybody's price goes up, which means that inflation goes up again, which means that I'm going to have to do another inflation adjustment where I gave 10% and now I'm going to have to give another 7%. And you can see how the spiral can continue and be a self-fulfilling prophecy. So then when you look at the supply shortages drove up margins, but they're going to fall, but you also have inventory at higher prices. So you're going to see inventories coming down, but can they pass through those higher costs, or are they not going to be able to pass it through fast enough, and they're going to have to eat some of that higher cost inventory because they won't be able to pass through all of that price as demand falls. So that's where it's going to be interesting to see how do we see margins going over the next few quarters as they try to balance inventory and balance cost based on what they were purchasing at. So now when we look at a divergence between manufacturing payroll growth and employment component of ISM manufacturing, So business employment in the ISM manufacturing, as we have seen, is now negative, so it's contracting. U.S. employees on non-farm payroll manufacturing net change still remains flat. Now, the problem with this is one is a leading indicator and more volatile than the other. So ISM manufacturing report, as you can see, is more volatile, but is indicative of a trend. And so that's when we look at this, it's just showing you that, look, hiring is going to slow, payrolls are going to come down. It doesn't mean they have to go negative. It just means that the trend is lower. And as we go into a recession, it's only going to pull it further down, because when you look at the extremes, which is where we are going on the business employment side on the ISM, we think that's going to continue to show that pull down. But ISM being more of a leading indicator versus the payrolls, which is a bit of a lagging indicator given when they're released and the data assumptions that are within them. So then when you look at the revisions are a cyclical indicator. So 2-month net farm revisions are negative. So again, you're starting to see those revisions coming down, seeing those less jobs being added than initially believed. Again, all showing some of those cracks that we've talked about. And as this happens, wages will come down with it, which we're also starting to see. So again, those leading indicators for the consumer. So June non-farm payrolls, again, they came in high. They came in at 372,000 versus the estimate of 268,000. So still that net positive. But when you look at the hiring announcements, they've now gone negative. So you're looking at what we had, which was a good jobs number, but now hiring announcements going forward are coming down. So just this is a leading indicator for that. Not to say that new jobs are going to be negative instantly. It just means, again, the trend is moving in the wrong direction. We're starting to crest. And if you look at the history of employment, as we talked about last week, you can still get job growth in a recession because, again, you have that lagging piece, but you start to cap out and then actually go negative, which we're starting to see here. All the while, that 5 million people are still out of the workforce, as we talked about. You have people who have retired, and then that second individual that just can't afford to work because their costs are going up and they have to stay home and not eat out as much, cook more at home, not pay for childcare due to these underlying prices, which is leading to the sharp move down in prime labor force participation, sitting at 82.3%. And obviously well off where we were in 2019. But as I said, in 19, we were too high. There were people that were holding out on retiring. There was a lot of glut in some of these in corporate America, and they used COVID as a way to get rid of some of this. And then people who were near retirement age or took buyouts and said, look, I'm done. I'm not doing this again. And they either went into consulting, they're picking up, maybe 10 or 20 hours a week in terms of work, and they like their lifestyle better. And that's some of those pivots that we're seeing here. So average hourly earnings came in at plus 5.1% versus the estimate of 5%. But again, when you take this and it's moving negative, it's coming down, and even though inflation's going up, which is why real wages continue to move further negative. Average hourly earnings appear to be flattening out and actually rolling over, again, speaking to what we've talked about with those pressure points, all the while when we look at some of the different pressures on rents and others. So after an 11.4% surge over the past year, median national rent for a one-bedroom apartment rose just 0.5% in June, while the median two-bedroom rent fell 2.9%. Costs are cooling in some largest cities. So again, you're still seeing momentum up, but it's starting to crest, starting to come down. We just think that at this point, as people are essentially locked in their homes and rent, it's not that rents are going to come down. It's just they're going to be very sticky at these levels, leading to what we've talked about on the sticky inflation front. So when you look at the largest weekly drop in the 30-year mortgage rate since December of 2008, again, more of a leading indicator because people just don't want, essentially don't want mortgages. They don't want to buy homes. So again, a leading indicator for where home buying is going. And then houses in serious trouble. So the decline in mortgage applications and higher mortgage rates point to much slower home price appreciation in the months ahead. It'll slow, it'll then cap, and it'll then start to go negative. So then when we start looking at the outlook for housing, continued decline for at least 2 more quarters. Existing home prices are still rising sharply, but that will change as rates continue to climb, which we've already seen. And that's where we continue to see this rollover. We continue to see some of these pressure points. And again, leading to some of these downward momentum in price appreciation. Because in housing, just like anything else, it's who is the next incremental buyer. So when you look at the makeup of who was buying previously, you had people that were willing to put down 50+% in cash. You had great credit scores. Those people who wanted to buy a home have bought a home. Those people who had great credit scores and were moving from the urban setting to suburban, they did that. Who's the next incremental buyer? And that's where I struggle. Who's the next? And I just don't, which is why we see that downward momentum, which is why when you start looking at more price drops than at any time since at least 2015, when you look at Redfin, 6.5%, are seeing the drop, more price drops than at any time before. But again, they're dropping prices from near all-time or at all-time highs. So yes, you're dropping prices, but they're still above where they should be. But there's a certain amount of emotion that comes into it. As I've described, if my next door neighbor, Bob, sold his home for $1,000 more than what I have mine listed for, I'm going to say, well, I've been in Bob's house and, I did more work and my house is nicer than his and my house is already $1,000 cheaper than his. I'm not lowering my price. Well, that's great. You're emotionally attached to your home, but the market won't bear it. So that's where, but that's where the fight comes in, because people refuse to take down pricing because they're grumbling that everybody on their block that doesn't have as a nice house as you, they sold it for a premium, which again creates some of this downward movement. And then the housing affordability index obviously continues to be at a record low, and that is not changing until we start to see some of that pressure on home prices. Deals in the housing market are falling through at the fastest clip. So again, 14.9% are falling through. So roughly 60,000 home purchase agreements fell through in June, which is equal to 14.9% of homes that went under contract. Home sales are getting canceled at the highest rate since the start of the pandemic. It could be mortgage didn't get approved. It could be it didn't appraise and they couldn't afford it. And then asking rents up 14% year on year in June. So you're still seeing that movement, but again, it's slowed. But when you start looking at these numbers, you can see there's still a lot of upward momentum for the CPI calc, which is why we see that continuing to move up. 52% of homes sold above list price, which is below 2021. For the first time since June 2020, the portion of homes selling for above list price decreased. Additionally, the average home isn't selling as far above list price as last year, but again, you're still at record pricing. So selling below list is still selling above where it should be. So, but again, it's just more indicative of direction and where things are headed. So 30-year average mortgage rate has declined sharply over the past week, but the gain over the past year is still amounted to 2.4%, which is among the strongest jump going back to the 1980s. So again, all of this leading to pressure and more of a stagnating piece, because again, home prices don't just collapse. As much as we'd love to sit there, everybody's waiting. It's like, I want to buy a home, but I'm not paying this price. It's going to take time, but we're there. We're seeing it, and this is the long-term issue that we see on U.S. GDP growth, because it's a big component of it, and we see a lot of downward momentum. So that's what we have for you in the U.S. In the next segment, we're going to go deeper into Europe and some of the issues that continue to happen within that region.